All right, well, welcome everybody. Thank you for joining us today. Um, my name is Andrew Daphne, and I'm the Instruction and Outreach Librarian at the New Jersey State Library. And it is my pleasure to present Larry Metzler and his son, Alex Conroy, who's also his assistant, for this presentation on asset allocation and modern portfolio theory. A little background for Larry. He is the president of Apogee Financial Services Group, Incorporated, the law offices of Laurent W. Metzler, Innovative College Funding Solutions, LLC, and president of the Morristown, New Jersey Society for Financial Awareness. Larry's entire career has been focused exclusively on financial planning, college planning, estate planning, retirement planning, asset protection and wealth preservation planning, personal and business tax planning, and real estate matters. So I would like to formally welcome Larry to this new NJSL Presents program. A few housekeeping items before we get into the presentation. If you have any questions, we'll be taking them at the end of the program, and you can ask them using the question box in the GoToWebinar dashboard, or you can email me directly at adauphinee@njstatelib.org. There are two surveys associated with this program. One is for the New Jersey State Library, and the other one is for Larry. Our survey will be prompted at the end of the webinar, as well as in a follow-up email to complete, whereas Larry's survey is currently in the handout section. So if you could please download that, complete that, and either send it back to me or to Larry, which his contact information is on the screen. That would be greatly appreciated. If you're looking for more information regarding maybe your portfolio or assets, you can contact Larry at his email, which is LMETZLER@APOGEE-financial.net, or you can copy down the link here to schedule an appointment to meet with him to discuss your own personal situations if you have questions that you don't want to bring in this somewhat public format. So, and I will be providing all of this information in a recap and as well as a recording of this later on this week. So before we get started, for those of you who are new to GoToWebinar, this is what your dashboard should look like. It should be very similar to this, and we'll just go through a quick rundown. If you do not see this dashboard, look for this orange box with a white arrow either at the top left or right hand side of your screen. If you click that, that will open and close the dashboard, so it is possible that maybe the dashboard was closed. Everybody is muted for this presentation, so you do not have to worry about the mute icon. If you have any problems or are running into any issues and you're not quite sure what to do, you can use this raise hand button right here. That will alert me that you have an issue with something, and I can reach out to you directly and hopefully solve any problems that you might be having. There will be in this handout section, it should say SOFA. It should be the start of the title of the survey, so you can download that from the handout section. And then in this questions section right here, you can just type in your question, hit send, and then that'll be sent to us. And again, we'll be taking all questions at the end of the program. So that is everything that I have for you. I'm going to give it over to Larry.
Hello, everyone. Hopefully, everyone can see our screen.
Looks good on my end, Larry.
Okay, excellent. So, folks, just by way of background, I've been in this business over 40 years. So during the presentation, I'm going to try to comment on some things that I think are relevant to where we are today in the investment universe, so to speak. Things have changed dramatically, as I'm sure you know, but I want to make sure that we have a fundamental understanding of what actually has changed by way of relationships between asset classes and so forth. As you see, SOFA is basically the Society for Financial Awareness, is a 501c3 charitable organization. I'm the chapter president in South Jersey. What we're going to be talking about today is asset allocation, modern portfolio theory. SOFA's programs run the gamut from very basically foundational to very sophisticated. This is a core foundational class. It's not high end from the standpoint of complexity. So hopefully those of you that have a lot of investment experience, I won't bore you to death. To those of you who do not, I think this will be very valuable to you. As you see here, nothing is sold during this presentation. This is strictly, again, educational. The evaluation form that Andrew talked about, you will get by way of email or it's already posted. So let's start. So common investment mistakes. Selling after the market has dropped significantly and then waiting to buy until the market has already made an upward major move. This is a very common problem in situations where decisions are driven by emotionality. So typically what happens is the client doesn't get in down here. Basically, they get in roughly around the 80% upside and then get out basically on the 60 or 70% downside. And as you can see, that math does not make any sense whatsoever. You never really get ahead of the game. What we're trying to communicate here fundamentally is that with an allocation model for each investment goal, what happens in the marketplace is secondary to the profile or to the investment policy statement. Another problem that we see occurring often is chasing last year's hot investments. I remember a time when people would come in and they just would get the annual Money magazine, which would give the top performing mutual funds in each investment class, and they would go out and buy them, and then they were kind of perplexed as to why their performance didn't come up to par. That's not what you want to be doing. Once again, the idea here is create a plan and then follow that plan. The benchmark index for domestic stock funds is the S&P 500, and this is an unmanaged index used as a general measure of performance. You can't directly invest in the index. I know, for example, if you looked at Vanguard's Index 500, that is a mutual fund that's designed to replicate the actual index. You cannot actually invest in the index per se. Change in market leadership is totally unpredictable. As you can see, here's a chart called a Callan periodic table of investment results, period of time 1996 through 2015. So you see here in 1996, 97, 98, the S&P 500 growth index was the leader. What happened in the next year? It dropped down not too far, but what came out was the Morgan Stanley emerging markets led the field, so to speak. In 2000 and 2001, what you see is the Russell 2000 value index led. S&P dropped. In 01, it dropped down almost to the bottom with a negative rate of return. We call this period of time, the 1999 through 2001, those of you that were in the markets at those times, that's the dot-com meltdown that took place in 01. And literally in the beginning of that period of time in 1999, any new company, any IPO that came out with a .com or a .net, people would buy it, and you can make money in the short term. Then, of course, you know what happened during that period of time, the market crashed. So the message here is that what was the leader 1 year, you see from 98 through 2001, 3 years later, it dropped almost to the bottom with negative rates of return. Meanwhile, you had 14% rates of return in the Russell 2000 value index. So what the message here is, obviously, what happened last year or 2 years ago is no predictor of what may happen next year or next month. Once again, market leadership is unpredictable. No investment category performs well over the same periods of time. Different categories frequently move in different directions. And once again, the leader in 1 year is often the underperforming in a year or two later. We say, fortunately, there is some light at the end of the tunnel. This whole idea of asset allocation, what is it and how does it work? So what is asset allocation? Well, it's the science or engineering behind the design of an investment portfolio, the output of which is what we call an investment policy statement. It's a strategy for creating a personalized portfolio by combining stocks, bonds, and cash equivalents in different proportions. The selection and the style of the class of investments, as well as the percentage weighting within each investment, is going to be predicated upon the investment policy statement. One thing I want to caution you, it doesn't matter what your brother, sister, father, mother, grandfather, grandmother do. That has nothing whatsoever to do with what is right for you. Oftentimes we see people who are influenced by their peer group or by family members whose strategies, whose investment tolerance, risk tolerance is entirely different than their own. So to try to compare yourself by way of performance or by way of design of portfolio should not be predicated on what those your peers or your family members are doing. That's a fault that we see happening all the time. The history of allocation started in 1952, so this is not necessarily a modern theory. 1952 is a long time ago. So Dr. Harry Markowitz, who was a statistician by education, developed the concept of what's called an efficient portfolio, or what we term it as an efficient frontier. And what each person's efficient frontier basically is statistically determined that for any given level of risk, there is a potential for a potential return. So if someone comes through my office door and says my expected rate of return is 12% compounded annually, number one, that's unrealistic. But number two, that would probably statistically say that about once every 1.6 or 1.7 years, that person who's looking for a 12% compounded rate of return could experience a 40% loss in their portfolio. And of course, you can imagine what happens during that conversation when you show the person, well, you could lose 40%. Is that okay with you? And the answer is no. So what you do on a teeter-totter basis is you're trying to lock in based on what the client's risk return concept is. So in other words, how much am I willing to lose to achieve an X rate of return? And you kind of center back in on what's a realistic rate of return versus risk portfolio standard for that particular client. Why is it important? Because proper allocation can lower the overall risk of the portfolio and can enhance the returns. This, again, is all statistically weighted. Now, one of the things I want to focus on with you folks is that, if, for example, if you looked at the long-term return on the S&P 500 over 90 years, that return is about 10%, 9.8% to be exact. However, over the last 20 years, it's 5.6%. A little bit later on, I'm going to show you or demonstrate to you why it's important not to necessarily rely on long-term historical rates of return, but to focus on what the returns have been in the near term. We'll define that by saying the last 20 years. Why is that so varied? Why is that so different? And number two, how does that compare to other asset classes' rates of return during the same period of time? So the specific investment mix that you choose, not may, I will be much more formal here, will directly affect the potential rates of return on your portfolio. And the individual asset classes may respond differently to the same market conditions. I will say, no, not may, will. So what you see here is a pie chart that talks about the importance of asset selection. And we're saying here that 91% approximately of what your portfolio will achieve, given its goal, is more predicated, 91% approximately, toward the allocation of the portfolio versus the specific investments that you make or choose, versus market timing, which we don't allocate, versus other factors. To time the market is, I think, a awful thing to contemplate. No one can predict, not me, not the wags on television. No one can predict what the market's going to do tomorrow. If someone says that they can, I would say run as fast as you can from that person or that entity. Traditional asset classes, well, what are they? We're talking about classes of investments. Well, there's three major classes. Stocks obviously tend to involve higher risk, but have conversely provided higher returns over time. Bonds tend to involve less risk, but also produce more conservative returns. Can also be used to provide portfolio income, and then cash or cash equivalents tend to be less risky and thus provide the most conservative returns, used mainly to preserve principal. Okay, I'd like to stop here for a second and talk about a concept called real rates of return. We want to make sure that your portfolio, irrespective of its goal has a positive rate of return after taxes, after inflation. And back in the day when you could get, for example, a 5% return on a CD, on a 5-year CD, I used to have a lot of what I call little white-haired ladies coming into my office, basically investing in CDs. Well, back then the tax rates were running about 50%. So a 5% CD after taxes would yield about 2.5%, and if inflation was running 3, you actually could see you would have a negative rate of return, and we call that going broke safely. So you always want to make sure that you're evaluating your portfolio to make sure that you are getting a positive rate of return after taxes if we're talking about a personal portfolio versus a qualified portfolio, meaning investments in your 401k, 403b, IRAs, for example. So if your personal portfolio, what is the yield on it? What's the return on it? If I have to pay taxes on it, what's my net return after taxes? And then if I apply the inflation rate for that particular time period, am I getting a positive rate of return? You want to know what that is at all times. Otherwise, you're losing money. So let me give you an example of inflation. In 2019, it was 1.81%. In 2017, or excuse me, 2018, it was 2.44%. In 2017, it was 2.14%. So currently, inflation is estimated to be about 0.62%. So as we talk further on about this idea of investing in cash or cash equivalents, the 30-year Treasury bond, I just looked it up before the webinar started, is yielding about 1.46%. So what does that mean? If I give my money to Uncle Sam for 30 years, I'm guaranteed a rate of return of 1.46%. Is that safe? Yes, absolutely. Is that something I should contemplate when looking at positive rates of return? Well, if inflation's running 1.81% last year, and the rate of return is 1.46%, whether it's taxable or not, I have a negative rate of return. So would investing in a 30-year Treasury bond be a sound thing to do? The answer to that sounds like it might be no, but predicated upon your risk return temperament. If you are like Warren Buffett, his favorite quote of mine is, before you talk to me about the return on my money, talk to me about the return of my money. If you are totally risk averse, maybe sacrificing a 0.5% of return on the 30 Treasury bond might be something that would make sense to you. So once again, three asset classes: stocks, bonds, cash equivalents. Now, again, if we focus back on the S&P 500 as being the benchmark index to measure the efficacy of the return on your portfolio, if you were to check the historical return on the S&P 500, once again, you'll find out that it was 9.8%. What has it been the last 20 years? 5.6%. So if I can't use a 10% return or a 9.8% return to project out what my portfolio may do, that is not consistent with the more recent terms. Moreover, and this is really, really important, I want to cement this idea in, the traditional relationship that used to exist between the stock market and the bond market no longer exists. Now, why do I say that? It typically used to be, if the stock market is going up, the bond market is going down. If the stock market is going down, the bond market is going up. Now, what did we see in the 2009 and 08-09 correction in the stock market? Were bonds going up? The answer is no. Absolutely categorically, they have not. What did we just see in the COVID reaction to the stock market? Was the bond market going up? No, it was not. It was not going up when the stock market was going down. Why is that important for you to contemplate? There are people in the stock market right now that are there simply to try to eke out some form of positive rate of return. The risk temperament is such they should not be in the stock market, but they are to try to get a positive rate of return. The impact of that has been to exacerbate the volatility in the stock market such that we have 5, 6, 7, 8% fluctuations in the stock market week to week. You need to make sure you understand that. Okay, moving on. Finding the right risks. Elements involved in the creation of an asset allocation model are expectations for rates of return. That's personal to you. Your time horizon, excuse me, and your risk tolerance. What's my investment profile? Many factors must be considered when choosing the allocation for any investment portfolio. Each investment should have funds allocated for the purpose of that investment only. Now, let's focus on that for just a second. My retirement portfolio will have a totally different investment policy statement than my college funding portfolio, than my portfolio to put a new roof on my house, to my portfolio to want to buy a vacation property. So when we meet with a client, and this is something you need to think about, you want to allocate differently for your various goals. So my retirement portfolio may be much more risk averse, excuse me, much more risk applicable, if you will, or willing to take more risk with my retirement portfolio than I would with my college funding portfolio if my child is going away to college in the next 3, 4, 5 years. Same thing, if I have hot money, meaning money I'm going to use for something in the next 2 to 5 years, that probably should not be invested in the stock market. Here's the following example of some questions you should ask to determine your suitable investment profile. How soon would we begin to take distributions from this account? Less than 2 years, 2 to 5 years, 6 to 9 years, 10 to 15 years, more than 15 years. Clearly, if you are in the less than 2 or 2 to 5 years, that money is not allocated properly to the stock market. We call that hot money. It's money that you could not afford to take the loss in the short term because you have a short-term goal. 6 to 9 years, some money in the stock market, more money in fixed income probably. 10 to 15 years, yes, I can certainly afford to take more risk with that portfolio because the law of time and large numbers take over. More than 15 years, probably more proportionate toward a more stock allocation than a bond or a cash allocation. How would you best describe your expected future earnings over the next 5 years? I expect my earnings, i.e. my earnings from my work, to outpace inflation. I expect it to keep pace, or I expect it to decrease. There's no right or wrong answer to this question vis-a-vis what actually you predict to happen. It's whatever you think is going to happen. However, that answer will affect the amount of stock versus bond versus cash in your portfolio. How long will your non-retirement savings last in the event of a financial emergency? 0 to 3 months, 4 to 6 months, 6 to 12 months, more than 12 months. Okay, you've all heard this idea of emergency savings. Rule of thumb is minimum 6 months. If you have 2 wage earners, maybe 4 months, but typically 6 months is what most people recommend that you have. If you have 12 months in savings, that's great. None of the 4 to 6 months should be in the stock market. None of it should be in long-term bonds. It could be a short-term CD, 6 to 12 months. It could be in a money market fund, so forth and so on. This is vitally important that you can, weather the storm in the event you get laid off or something happens to your portfolio. Issue close to my heart here. How much money of your monthly income do you use to pay installment debt? Hopefully, everybody on the call is A. Probably not the case. Less than 25% monthly income goes to pay installment debt. 25 to 50% goes to pay installment debt, more than 50%. Folks, if you are in the D category, you want to have a meeting with your financial advisor and map out a plan to get out of debt as quickly as possible. I'll make a comment. You can argue with it. I say there is no such thing as good installment debt. But Larry, I have a 0% credit card or a furniture or whatever the case may be. Okay, you might be able to bend my arm a little bit to accept that. However, in most instances, if you have a credit card or you have some form of installment debt, the amount of interest you're paying on that debt will far and away exceed the amount of money you've earned on your portfolio over the last 20 years. Once again, the 20-year return on the S&P 500 is 5.6%, including 2019. Most installment debt on a good day starts at 12% and goes up to 26%. So here's something I want you to think about. If you are getting a match on your contributions to your 401k, 403b, whatever the case may be, your employer-provided retirement plan, and you have installment debt, do not put $1 more into those plans than is necessary to get your maximum match. Anything over and above that you have, start paying off your installment debt. Get rid of it as quickly as possible. That is critical to wealth building. The sooner you get out of debt, the more you're putting away toward your retirement. It's a disciplined approach. We can talk about that later should you choose to do so. Are you willing to take on more risk for your investment performance to exceed inflation? Again, there's no right or wrong answer. If the answer is yours and yours alone, to the extent that you say yes, obviously, that's good. To the extent you say no, that's bad, no, neither is good or bad. It's a switch, yes or no. However, that will be a driving force toward the establishment of the risk return percentages in your portfolio. How long would your non-retirement savings last in the event of financial emergency? How would you respond to the following statement? Protecting my portfolio from a loss is more important than achieving high returns. Would you answer A, strongly agree, agree, risk return are equally important to me, disagree, or strongly disagree? Once again, these are weighted questions that go into the preparation of the investment policy statement, which at the end of the establishment of the investment policy statement will create the asset allocation model for that particular investment goal. Great question. From the original investment of $40,000, your portfolio went up to 80. Yes, you're euphoric. Uh-oh, but suddenly that drops by 20% or $16,000. You now have $64,000 in your account. How would you react to that event? Would you sell the investment entirely? Would you make no adjustments whatsoever? Would you make additional purchases in the current portfolio? And if so, in what investment classes? Or D, I will try to avoid the investment drop 20% from inception. How would you answer that question? Again, everyone on the call may answer it differently. Again, there is no right, wrong, or in-between answer. It's whatever answer is appropriate for you. The folks who are going to react by selling out are the ones basically that maybe should not be in the stock market to begin with. I'll make that as a commentary. Okay, so now the portfolio dropped by 20%. You're now at 64,000, and then 2 weeks later, 2 months later, the portfolio drops by another 15% or $9,000. How would you react? Once again, would you sell the investment entirely, make no adjustments, make additional purchases, or try to avoid the initial drop in the first instance? How would you react to that? How would you best describe the depth and length of your investment experience? A, I have no experience whatsoever. B, I have some experience. C, I have broad experience. Experience is not just how long you've been in the market or how old you are. Experience comes from what I would call doing a lot of due diligence, spending a lot of time researching these concepts. I'm going to refer you to a website. It's called yahoofinance.com. Some of you may be on it from time to time. Some of you may be on it all the time. Some of you may not have looked at it whatsoever. I would strongly suggest you get onto that website, spend some time there. Doing what? Researching concepts, researching how the investments you've chosen to invest in perform against their benchmark indexes. I'm going to make a bold statement that I want you to follow up on and prove me wrong. If you are in a domestic stock fund, I want you to go on yahoo.com, get the symbol for that stock fund, look at its 5-year performance, 10-year performance, and 20-year performance, and then superimpose on that fund's performance what the S&P 500 has done during that same measuring period of time. What you will find out is that none of your funds have outperformed the S&P 500. That's a bold statement. I want you to prove me wrong. If you find a fund that has outperformed the S&P, again, the domestic stock fund, I want you to email me and tell me what fund that was, because I haven't found one. Why is that important? Because what happens here, the reason that your fund that you may be invested in has underperformed is because of fees. Some mutual funds have exorbitant fees. Some mutual funds have very, very modest fees. But point in fact, the fee you pay undermines the actual performance of the S&P 500. So for example, if I was in the Vanguard S&P 500 fund, that has a load of about 30 basis points, 0.3% is probably the lowest performing fund out there. But if I compare again the performance of that fund against the actual S&P, it's underperformed by what? By the fee. In my example, 30 or 40 basis points. So once again, every fund that you are invested in, if it's a domestic stock fund, compare it to its benchmark index, and you will find you've underperformed. That takes people back a little bit. Here's some sample portfolios that don't represent any guarantee of return. They're just examples to give you some idea of how you may allocate depending upon your risk return temperament, or what we call your investment policy statement results. So the conservative portfolio you can see here has 35% in stocks, 50% in bonds. There's a misnomer there, not bond equities. A bond is not an equity. In bond funds, there should be, or bond investments, and 10% in the money market account. This is a very conservative portfolio. Moderate portfolio, 50% in stocks, 40% in bonds, 10% in money markets. Moderate growth, 70% in stocks, 20% in bonds, 10% money market. And of course, an aggressive portfolio, 100% in stocks. Now, within the category of stocks, obviously, you can see here, we have large cap growth, large cap value, large cap blend, mid cap small, mid cap value, mid cap blend, foreign stocks, bonds, and money market accounts. Be very careful when you look at, for example, a global fund. Global sort of suggests, if you will, that this bond fund, or excuse me, this stock mutual fund invests predominantly in non-US securities. Typically, what you will find in most global funds is about 60 to 80% is in domestic stocks. So while you may, if you did not know that, think you're getting diversification by way of geography, you may in fact just be reinvesting in the same funds or the same companies that these other funds are invested in. If we're talking about an actual foreign fund, for example, an Asian fund or a Chinese fund or something like that, you are investing predominantly in the stocks of those particular countries. Once again, please don't use this as any way of a guideline to say that if I consider myself conservative, this should be my portfolio. That determination should be more expansive by way of formulation. Okay, how can all this help me? Asset allocation can be applied to your different investments. Again, once again, we're talking about what is the goal of your investments. Separate profiles should be completed for each investment within no particular class or goal. Meet with a financial professional to review your profile. And if you don't have a profile, to establish a profile, ensure that your answers are consistent with your goals. You should be meeting with your advisor about every quarter to make sure that nothing has changed in your situation. That's the first question we ask our clients when we meet with them or converse with them is, has anything changed since our last meeting or our last conversation? We want to make sure that the investment policy statement is always consistent with where you are in place and time, and nothing has changed to dramatically change the investment portfolio formulation or allocation. What might change? You lose a job, someone loses a job, your spouse or you. You get a raise. You have an inheritance. Someone gets sick. Anything along those lines might engender a conversation, again, back toward this idea of should our profile change? I can tell you after 08 and 09, there were many conversations because the risk return temperament that people thought they have was dramatically changed. You lose 40% of your money, I can tell you that may change your orientation toward your risk return. I also want to point out, and this is vitally important, if there's anybody on this call that's within 5 years of retirement, please email myself or Alex. We'll get a white paper out to you called Sequence of Return Risks, the effect it has on your portfolio allocation. That's authored by a fellow by the name of Dr. Wayne Fowl from the American College It postulates a theory that when you enter the realm of 5 years before retirement or 5 years after retirement, you cannot categorically take the kind of hit that people took in 2009, i.e. lose 38, 39, 40% of your portfolio during that period of time. It requires a reevaluation of where you are if you are in that critical period of time vis-a-vis your asset allocation mix, if you will. Okay, so that's all for me. We can take any questions, Andrew, that the folks may have at this point in time. Please fill out the evaluation form that Andrew has available for you. And I think at this point in time, we'll take some questions.
All right, thank you so much, Larry. Yes, if anybody has any questions, again, you can submit them using the question box in the GoToWebinar dashboard, or you can email me directly, and my email is adauphinee@njstatelib.org. So let's. All right. What's the best first step to take in getting debt paid down?
Great question, Andrew. Okay, so this is contra to what you may, it's kind of counterintuitive to what you may think. So let's say I have Mr. Smith who has 4 credit cards, 1,000, 2,000, 3,000, 4,000 on these credit cards, and the rates range from 12% to the low to 26% on the high. So what typically people do is they'll try to add a little bit to each payment each month to try to chip away at the balance. What you want to do is take the card with the lowest period of time to pay off. So if you were paying this card off, it's going to take 12 months to pay this particular card off, irrespective of the balance or irrespective of the interest rate. You want to pay off the one that will take the shortest period of time, take any excess payments you were making on the other cards, add it to that one, pay it off. So let's say the person was paying $50 a month on that particular card and $10 a month on all the other 3. When you pay off that first card, you now have $50 a month cash flow plus $10 from the other 3, or $80 a month. You're going to take that and allocate it to the next shortest payoff. You pay off that next one, you're going to take what you were paying on that one plus what you were paying on the first one, add it to the third one. Pay that one off, add it to the fourth one. And then lo and behold, once you get all those credit cards paid off, what we would do is say, take a look at your mortgage and see what would happen if we took all of that money you were paying on your credit cards, allocated to your current mortgage. I will tell you guys, it is not unusual for us to run through this and pay off all debt and mortgage within 11 years on a 29, 30-year mortgage. So completely out of debt, including mortgage payoff in 11 years. That's not unusual.
All right, let's see. And a follow-up to that, why wouldn't you continue to have a mortgage?
Oh, okay. Because typically what happens is we know we're constrained now by our tax deductions from mortgage, right? Interest. It's difficult, again, under the current tax regime to get above your standard deduction. So while Uncle Sam is subsidizing your mortgage, let's say you have a 4% mortgage and you're in a 30% tax bracket. So 30% of 4 is 1.2. So your effective after-tax cost is 2.8%. The question would be, if I didn't have a mortgage and I took my mortgage payment, could I get a return that's higher than 2.8%? The answer typically is yes.
All right. Could you repeat what you said about emailing you for a sheet if you're within 5 years of retirement? And your
Yes.
email address, I will send out your email address directly.
Yes. It's a white paper by Dr. Wade Fowle.
person said thank you for the information.
By the way, the concept of credit card payoff is not mine. If you're familiar with Dave Ramsey, it's called snowballing your debt. So if you're not anyone who knows of Dave Ramsey or follows his concepts, he's someone you want to kind of do a little bit of research on.
Or some other people would like the white paper, so I am going to post your email in the chat, so then it'll go to everybody.
Okay. Mm-hmm.
Someone asked about the evaluation form. You can either send it to my email address, which you can get. I will send everybody a follow-up email, so you will all have my email address, or you can send it to Larry's email that I just posted that everybody should be able to see. So. And again, if people have personal questions, they can always email Larry. And if you would like to talk about things more in depth with Larry, I will also be sending out his invitation to schedule an appointment as well. So be on the lookout for that. Let's see. Could you discuss the advantages or disadvantages of using a fiduciary financial planner?
Sure. Yes, absolutely. This is going to be a biased answer. We are a fiduciary. We are a registered investment advisory firm, so we are fiduciaries. So what it goes to, folks, is the issue of legal standard or what the duty is owed to the client. So a fiduciary owes an absolute duty of good faith from a legal standpoint to the extent that they would act in their own best interest versus the client's best interest that is legally actionable. So I would say, again, I want to caveat by saying we are fiduciary, so if it comes across as being non-objective, please forgive me. But the standard of duty for the typical advisor, for example, Morgan Stanley broker-dealer, is know your client. So know your client means if essentially the analysis of the client's needs say, okay, I can put you into this limited partnership and make a big commission on it, but I can defend that by saying it's within the parameters of a risk return temperament. That's not a fiduciary based decision. So again, think in terms of the fiduciary's obligation legally is what is in my client's best interest. If I don't do what's in my client's best interest, I can be sued for that versus know your client, which is I thought it was in my client's best interest. It turned out not to be. Well, that's good, but you can't sue me. So fundamentally, that's the difference. A good example of breach of fiduciary would be selling a client a loaded mutual fund, meaning as a front end load of 3, 4, 5%, not disclosing that when you could have put that client into a no load fund with the same basic objective.
All right, I don't see any more questions yet. So we'll give it a couple more minutes and see if anybody has anything. All right, well, I don't see any more questions coming in. So again, I'd like to thank you, Larry, for presenting today. It was filled with a lot of good information, and we definitely appreciate your time.
Oh, my pleasure. My pleasure, Andrew.
Somebody said as a follow-up, I guess a fiduciary financial planner normally charges a certain percentage of the portfolio. Is that correct?
Uh, what happens is typically there are what they call fee-only planners, and they charge a fee to prepare the plan. They don't manage the assets, and they don't sell products to, they don't sell mutual funds or stocks or bonds to fulfill the investment needs. We design the plans basically for no charge, and if you choose to use us as the investment advisor, we charge a fee. So that's the difference between the two. It's just a matter of style. You want to get paid for doing the plan, but don't be involved in the actual management of the assets, or do the plan as a courtesy for the client and then manage the assets should the client choose to use you. There's no, not to use a popular term, there's no quid pro quo necessarily to the way we do it. If we do a plan for a client, that doesn't necessarily mean you have to hire us to manage the assets. That's up to the client. We kind of invest in that process from a time standpoint.
All right, well, thank you so much, Larry. Again, if anybody has any questions, I sent out his email, but you will also receive it in the follow-up email that I'm going to send out with a link to the recording. And thank you for everybody attending today. I hope you all found this very informative, and be safe, be well, and hopefully we'll see you again soon. So have a great
Thank
day.
you, Andrew. Be well.
Thank you, Andrew.